My next guest says American exceptionalism is peaking and preparing to go join Japanese from 1990 and Chinese exceptionalism from 2010 in the tank. That's some strong words from Bill Smead. He's the chief investment officer at Smead Capital Management. So, Bill, I mean, I think of you as a real patriot, and this is quite a word of caution from you.
Well, yes, the people are confusing political improvements with an effort to extend a euphoria that Charlie Munger called the biggest of his career because of the totality of it. See, this is euphoria. We put out a piece right after the election euphoria of the first couple of days. And if you look, I think the S&P is lower than it was a couple of days after the election day euphoria. And that's because go back to 1980, Ronald Reagan was going to be great for business, and Paul Volcker did what he had to do to break the back of inflation with 18% 90-day T-bills, while Reagan stood down the air traffic controllers, psychologically breaking inflation. But despite that, the market went down 22% over the first 21 months of his term. And that's with record low participation in stocks. Stocks that went from 7.5 times earnings on average to 6, and we've started out this with the most expensive market as measured by 7 or 8 main ways of measuring, like Buffett's GDP to market.
So let me just back up for a second, Bill. I mean, do you? What we're all trying to figure out is, what does this mean? Let's just say for the S&P 500, for investing in the stock market. You know, I see some making the argument that as these government jobs are trimmed, that will make the U.S. economy more productive in the long run, for example. That doesn't sound like the argument you're making. You see this as more, how do you expect this all to play out exactly? No, the argument involved, it has to do with the economy, the on-the-ground economy. And people have to understand that from 1964 to 1981, the on-the-ground economy did great and stocks did terrible. They've got to realize there was a lot of inflation during that period. I don't know if they'd say it was doing great.
Well, think about it like this. We went all the way to 1/4% interest rates from 18% T-bills in a 40-year stretch. Of course, people bid the price of common stocks up in reaction to that. The future income stream got more valuable as the riskless rate went down. The riskless rate is no longer going down, and people are ignoring it and continuing to bid up very exciting stocks that are the last major trend, which was technology, FANG, then Magnificent Seven, and now AI. And that is the last trend. They're bidding that up, even though we're at the point where in prior historical circumstances where a very legitimate development came to pass, you had to start getting away from it. So to me, it's very bizarre that the riskless rate is going up despite the Fed cutting rates for a while, and people continue to capitalize tech and growth and quality, wide moat, 35 times earnings stocks, and putting 60 times earnings on Costco like they did Coca-Cola in 1972.